There is an increasing appetite for global equities. Here to tell us how ETFs can help you diversify your portfolio into international markets is Georg Clapham, and George is from 8Buys. George, great to see you. Or can I call you Geordie? Sorry, it's a little in-house joke here. Yeah. Okay, so Australian investors have typically enjoyed the fruits of bank shares, their franked dividends, resource companies, but international shares are also really important.
They certainly are, and thank you for having me, Danny, and it's great to see you. Yes, if you look at the context of the Australian market, so originally I managed Australian equities for a number of years, 20 odd years. And as an analyst, beginning as an analyst, and back in those days we actually had quite a diversified market. In fact, in 1960, most of the market was not in banks and resources. We had manufacturers, we had industrial companies, we had lots of different niches, and that all changed. In fact, today, the Aussie market is 75% banks and resources, 40% big banks, 30-odd% in resources and energy. So if you're looking at just buying the Aussie market, we are very much dependent on those two sectors, which I call sort of sector concentration risk. So when I look at diversification, I always look at diversifying on an industry basis. And most Australians are underweight, if they are wholly invested in Australian equities, growth industries or industries that, of the future. So for example, how many enterprise software companies do we have in Australia? How many cybersecurity companies do we have in Australia? Aerospace and defence, these sorts of sectors. And so the only real way to get industry diversification is to go offshore. And we at 8Buys have been investing in global ETFs, but only on the US market because it's the biggest, deepest market in the world. And in fact, today there's about $1 trillion worth of ETFs just in the industry space alone. So most people would be underweight, say, semiconductors, for example, which is a massive $500 billion industry growing between 5 to 10% per annum. Now, do you want to be part of that growth? The only way to really access it is to buy companies within the semiconductor industry. You can buy that either directly by picking stocks, or you can buy a basket of stocks within an ETF.
Okay, so taking it back, so 8Buys, you basically are an investment fund that invests in a suite of ETFs specifically into the US. So you're basically taking the challenge for Australian investors of picking which ETFs, which sectors to go into, and you're managing it from that perspective. Maybe run us through some of your favourite sectors at the moment. You've mentioned semiconductors. There's obviously, as you said, software, technology. We all know we've been talking the Magnificent Seven, until the cows come home, but they really have been magnificent when it comes to performance. So what do you like at the moment?
Well, our biggest overweight was probably one of the worst sectors of 2022, believe it or not. So I always like looking at the worst sectors of 22 or the previous year. And that was social media, search, and streaming.
Yes, so you've absolutely kicked the ball out of the park with Facebook and Netflix.
Facebook, Netflix, Google, etc.
Yeah.
But even if you take streaming, well, there's a big change in the industry happening now. There's two things that are going to drive streaming. One is ad-supported streaming, so there's a whole new revenue driver for that. And secondly, we think there's going to be industry consolidation, which means greater concentration, which improves industry returns. But clearly Netflix is the leader there, but there are other players that are not profitable. Disney's got a couple of 100 million subscribers, so that's a really interesting sector. And you only have to look at stocks like Disney, they've been beaten up, etc. So that's still interesting. Social media, Meta's now looking at, if you look at their growth in users, that's been positive, but also they're still tweaking revenue per user. Even in Europe at the moment, they're looking at even a paid service. So there's a lot of potential there in terms of driving RPU. And then search, people are worried about Google search, but then if you use Google search and you use Bard, which is their AI service, you tend to be searching more. You're on the site longer, which Bard is the competition with ChatGPT. So we're still pretty constructive on that. So that area. The area which has been the dog of the year, which we're overweight at the moment, has been healthcare. And healthcare is interesting because it's been a two-edged sword. You've got the growth in GLP-1 drugs, Eli Lilly and Novo coming up with now, Lilly was just approved the other day for its obesity drug. And that's cut a swathe of concerns for earnings for the other companies because, yes, they might, weight loss is important, so you don't need as many hip replacements. Potentially there's impacts on sleep apnea. So we've seen a lot of those other stocks in the healthcare sector now being discounted. And so they look attractive from a value point of view. So those two sectors, we're sort of heavily overweight. We're not exposed to commodities and resources because, you get that here. So we're sort of offering a strategy where people can go offshore, get exposure to those industries because they're already overweight banks and resources if you're an Australian investor.
Yeah, what about the likes of the industrials over in the US, some really big names over there, or aerospace? Is that a sector? And the other one that has been decimated this year has been the financials. Now, it might be the same case, you don't want to go US financials because you've got the alternative here in Australia, but maybe a couple of other sectors that are bombed out that you like.
Well, Danny, I'll just take financials. There was a big change in one of the largest ETFs, global ETFs, which is the XLF, about the middle of this year, where Visa, MasterCard and Amex, which are the big payment service providers, moved out of the tech sector. Believe it or not, they were sitting there into the financials, into that ETF. So that was a big structural change to that ETF. What does that mean? That means that ETF, I think, got a lot better because those are great companies, and so there was exposure to regional banks that got absolutely pulverised during the year, but there was a very small segment. So you've got in that ETF, you've now got payment service providers. You've got the JP Morgans, which actually benefited from the demise of other banks because they were buying all these banks for virtually nothing, discounts to NAVs. So that sector's okay, not a lot of growth, and then you've got the insurers, so Berkshire Hathaway in there and some of the other, which are benefiting from premiums. So we are modestly underweight financials because there's not that amount of growth, but there's certainly good value there. And then if you look at industrials, that I think will be the real next beneficiary of AI and generative AI I'm talking about, because there are process-driven companies, and if you take the largest industrial ETF in the US, about a third of that is aerospace and defence. Well, that's been quite strong. So your Raytheons and Boeings, et cetera, have been strong. But also you've seen the revitalisation of American manufacturing. So GE's I think GE's up about 80% this year. It's been reformed, it's split itself up, it's going into the areas that it's good at. And so I think the benefits of AI and robotics will flow through to those areas. And then the other area which I think is interesting in industrials is the Japanese industrials. So the Japanese industrials, as you would know, as people should know, robotics, Japan dominates industrial robots globally. There's some German companies, but essentially they've been sleepers. They are, they're the sort of future growth areas, and I think, Buffett's probably right in picking some of the value in Japan, and you can get that through, the exposure to industrials and robotics, which is we're overweight.